Nitin Rakesh from Motilal Oswal Asset Management Company is with us. Soon some other experts will also join in. Nitin, morning. How worried are you about what's going on in the world now and the way it's led to that crude spike?
Morning, Udin. I think clearly the events in the Middle East have managed to kind of not only continue from one country to the other, but also surprised a lot of the analysts that predicted it to be a much more contained phenomena. It doesn't really spell very good news for us from a crude oil perspective. I mean, we've clearly seen the spikes gone, well past $100 and stayed there. If anything, it's actually only gone higher. So I think clearly we have a predicament. The government budget will set out what we're going to do on the fiscal deficit front. Oil marketing companies obviously can't bear the brunt of this current kind of crude prices unless either the taxes are lowered or prices are increased. So I think we clearly need a direction on that front, and that will continue to cap the upside in the markets, at least in the short term.
Nitin, morning. We have a pretty high sensitivity as well to every per dollar increase in crude, as we've seen in the past. What kind of downside risk do you think has opened up for the market because of this situation?
I think, as I mentioned, the only two ways out of this situation either are that we take a stance that we took 3 years ago and effectively absorb bulk of the crude price oil increase and effectively created a big oil subsidy bill for ourselves. The other way is to effectively deregulate completely and do away with the subsidy. Now, I think we have to have some middle path that the government will set out for the budget. So I think clearly investors don't like to see bleeding upstream companies or even upstream companies. So clearly there has to be a certain balance that has to be laid out, and there is clarity awaited on that front.
Expectations are running low in any case from the budget, Nitin, but have these developments made it even more of a marginal issue?
I think it's not so much a marginal issue thing. I think people really want, as I said, the focus of the budget seems to be on two fronts. One, how are you going to contain our fiscal deficit? Because that seems to be the biggest macro question everybody is asking right now, especially in the wake of slowing FII flows, because they won't really step in to give you the short-term flows that you needed. So I think since we can't have any cuts on the planned expenditure side, the subsidies really then come into question. So it's food, oil, fertilizers. Clearly, these are three segments that investors are going to watch out for from a subsidy point of view. From a revenue generation budget point of view for the government, even if you include the disinvestment revenue of 40,000 crores, current fiscal and probably a similar number next fiscal, we still really have a certain shortfall that government will need to fulfill. So then you bring into account things like goods and services tax and the DTC, and I think we need some direction on that front as well. So I think it's really a question of how the government is going to lay out the roadmap for containing the deficit and carrying forward the tax reforms, because those really tie into the deficit number as we speak right now.
You were speaking about the deficit, Nitin, and a large part of the deficit containment this year happened from asset sales. But the way crude has spiked, the first big one is ONGC FPO. But what happens there with complete lack of clarity on the oil policy? Do you think they can go ahead with the FPO in this environment unless they choose to bite the bullet one way or the other?
I think it's not just ONGC, it's ONGC and IOC both, and I think both of them are kind of gearing up for an FPO at some point in the next few weeks, in fact. So clearly, that remains the big question mark, and that's why I think the budget is not so much about anything but how the government is going to clarify what we're going to do about these expenditures that are non-planned expenditures. So I think clearly, at least in our minds, those are the two things we are focusing on. Can we see some more clarity on the tax front, because that really ties into the government revenues, and can we see some more clarity on the non-planned expenditure front?
But if that happens, then you might get clarity on that front, but the government or the finance minister may only be able to guide a 5.2% kind of fiscal deficit for next year, which may make the market very unhappy if it's absorbing this oil issue.
And they're clearly looking at below 4.8 odd is the target that at least we are expecting, and I don't know whether the market has discounted anything better or worse, but clearly that's why we have a macro headwind that it's not going to go away anytime soon. Events in the Middle East haven't helped us at all. The global growth hasn't helped us, because that continues the pressure on the inflation front, primarily based on the raw material prices that most companies are looking at. So I think it's a little bit of a headwinded situation, at least for the next 3 to 6 months. It looks like we'll have to discount these issues. The markets will have to live with these. So far, I think we've held up really well in the last couple of weeks after we made some sort of a bottom around 5,200. But I don't think we're out of the woods yet, purely on the basis of some of these events that we are foreseeing right now.
We haven't lost that much money either, Nitin. I mean, for the month to date, we've lost about, what, $400 million in terms of FII outflows. Do you think these developments might be the catalyst to accelerate the outflow situation?
I don't think the outflow is such a big worry. I think the issue really is what's the next trigger for the market. I mean, we had $30 billion of inflows last year and the market was up 18% for the calendar year. And we've had, less than $2 billion of outflow this year and the market's actually down that much. So I don't think it's really a question of we worrying about outflow so much as what's the next trigger for investors to continue to actually bring more money in. Based on what we think, feedback from FIIs, I think it's at this point in time they're underway to neutral at best, which basically means that even though they may not be driving money out in hordes because of this whole developed markets and emerging markets, rebalancing play going on, but clearly it's going to have there has to be a significant trigger for them to actually reallocate money into India, and we are competing for capital with the likes of US, Germany, no less. So I think it's not an easy slam dunk that it was 2010. So the bigger question really is what is that trigger that will actually bring capital inflow back in. I don't think outflows is going to be that significant a number.
Oil has become front and center as an issue only recently, Nitin. The market has been extremely worried about infrastructure as a space. How would you approach that, A, and how much do you think the budget could actually do for that sector, B?
I think the biggest worry in the market really has been the cost of borrowing for that sector, because it's a very, very capital intensive play and it's one of the most interest rate sensitive sectors as well. So I think it's really a question of at what point do we think that we've peaked our monetary tightening cycle. In addition, I think while the order books continue to stay okay, we've not seen that kind of an acceleration in the capital goods books either, based on the last quarter numbers. So I think there's clearly a certain headwind that sector continues to face, whether you're in construction or you're in capital goods. I mean, that's clearly reflected in the numbers of both L&T and BHEL in that order. So I think what budget can do for them, clearly, besides outlining another, infrastructure planned outlay, I think there's very little scope that will give the companies or the share prices in the short run and any big boost, purely on that front.
Nitin, what did you make of the Reliance deal, and what kind of range do you think the stock will likely hold over the next few months?
I think calling the range is a little tough, but clearly the deal has done a couple of things for the stock. First and foremost, I think the balance sheet's actually become very, very strong and clearly has lifted a certain amount of gloom from the stock in terms of what concerns people had. Secondly, I think the impact of having access to the technological inputs that they need for the gas blocks, I think is clearly a big positive. Based on what we've seen in the last 24 hours, most sell-side firms have upgraded the stock. It looks like we probably have an environment where the stock will actually perform much better than it has over the last couple of years. So I think it's good news for the company, it's good news for the market, it's good news for that sector per se. And I think what seemed to have been a very dull and tedious effort now seems to have actually moved on to a different plane altogether. So I think we're fairly pleased with what's happened in the deal. Obviously, we need some more clarity on taxes, for example, or the use of funds in Reliance balance sheet, but I think those are matters of detail.
Nitin, if your call is that the next few days might be quite shaky for the market, how do you expect the broader market to perform in that light?
I think the direction will really be set by the larger names, and considering that there's a fair amount of news flow expected either from the Middle East or from our upcoming budget on Monday, I think it's really not a call on segments, whether it's mid caps or large cap. I think it's really is a unified call on what the overall direction of the market is likely to be. So I think at this point we are more focused on these events getting priced in. And once you have that opportunity to understand the direction for the next 1 year based on the budget, I think we have a better chance to evaluate the broader market. Having said that, I think we definitely continue to use this opportunity to buy into things that are in very, very comfortable valuation ranges, something that was not true for maybe 2 months or 3 months ago. So I think clearly, we don't think that it's a complete washout situation right now. So continue to use this opportunity to kind of buy into names that you have high conviction on.
Nitin, how do you approach the interest rate sensitives now? Because they seem to have started underperforming again with the spike in crude, perhaps on inflation fears. Banks, autos, infra, they're all doing poorly for the last couple of days.
I think there are not just crude, but also the interest rate cycle itself. But again, I think some of the fears are a little overplayed, especially on the banking side. Considering that there's been twice an increase in base rate without any corresponding increase on the deposit side. We don't think there is an impact on the margins that market is pricing into, and some of that came out in the numbers for last quarter as well. Credit growth is pretty good. So I think on the banks, we're pretty confident and comfortable. On the autos, situation needs to be monitored, because if the government decides to roll back the excise cuts from 2008, and bring that back into the play right now, then obviously the dilemma for auto companies will be whether to pass it on to the consumers or take an impact on the margins, both of which is not a very favorable situation right now. So I think so far volume growth seems to be okay, but there are some concerns on the margin front, and I think we talked about infra earlier. So I think clearly one needs to wait and watch out for the interest rate cycle to peak out. Inflation looks like it's going to be within the RBI range by the end of this financial year. And I think, at that point in time, I think as the markets recover, we are fairly confident that at least the banking space will definitely have the juice to outperform. But I think one needs to kind of sit through this phase till we get the peak of the cycle.
Nitin, tactically, how are you guys approaching the budget as an event? I mean, are you going in very light, keeping cash levels high? What are you recommending doing?
No, I think the idea is not to keep cash levels high, but clearly, as I said, we are focused on what the direction will be laid out in terms of some of the events on, for example, deficit, non-plan expenditure, and the tax reforms. But I don't think call is to actually stay cash or not, because I don't think the impact on the market is going to be that significant, at least in a short-term period. Yes, there's going to be volatility, but I don't think the idea is to try and using the volatility